The cost of living in America is climbing faster than most of us can keep up with. From skyrocketing grocery bills to relentless rent hikes, inflation is touching every corner of our lives. To make matters worse, rising interest rates are turning borrowed money into an ever-tightening noose. This isn't just an abstract economic trend, it's an unfolding crisis with real, tangible effects on millions of Americans. In this video, we'll unpack how inflation and interest rates are pushing households deeper into debt, how it's shaping the middle class, and, most importantly, how you can protect yourself in these turbulent times. The hidden costs of borrowing, 2023, was the year that interest rates hit levels not seen in over 2 decades. To combat inflation, the Federal Reserve raised rates repeatedly, pushing them to over 5.5%. For context, in 2020, these rates were close to zero. On the surface, this strategy is meant to cool spending and bring inflation down. But for everyday Americans, the reality is far more painful. Higher interest rates mean that everything tied to borrowing costs more. Credit cards, mortgages, auto loans, and even small business loans now carry much heftier price tags. Take credit cards, for instance. With average interest rates topping 24%, paying off even small balances can feel impossible. Many families, already stretched thin by inflation, find themselves turning to credit as a lifeline, only to be crushed by mounting debt. Inflation's relentless grip. While inflation has cooled from its peak of 9.1% in mid-2022, it's still well above historical norms. As headline inflation appears to ease, the reality on the ground tells a different story, where the costs of essential goods, like groceries, fuel, and healthcare, continue to outpace wage growth, putting an increasing strain on middle and lower-income families. While the official inflation rate may have dipped from its peak, it's important to note that cumulative price increases over the past few years have fundamentally altered the financial baseline for millions of Americans. By late 2024, the inflation rate stood at 3.7%. That might seem manageable, but here's the catch: wages haven't kept up. A recent survey found that 61% of Americans are living paycheck to paycheck, a stark reminder that even modest inflation has severe consequences. Families who once felt secure in their financial standing are now finding it nearly impossible to balance the rising costs of housing, healthcare, and education while still planning for a stable retirement. Credit card debt has transitioned from being a convenient tool for managing short-term expenses to becoming a financial albatross, with soaring interest rates turning even modest balances into long-term burdens that many will struggle to pay off. The middle-class squeeze. The middle class, often considered the backbone of the economy, is feeling the pinch more acutely than ever. Here's why. Housing costs. The dream of homeownership is fading for many as mortgage rates climb past 8%. For renters, rising demand has pushed rents to historic highs, leaving little room for savings. Savings depletion. Families are draining their savings to cover basic expenses. Emergency funds that were bolstered during the pandemic have all but vanished, leaving households vulnerable to financial shocks. Retirement delays. Many Americans are cutting back on retirement contributions to manage day-to-day costs. For first-time homebuyers, the dream of owning a house has become even more elusive, with down payment requirements and monthly mortgage rates becoming harder to afford. Businesses are also affected. Higher rates mean fewer investments, slowing economic growth even further. This short-term survival strategy could spell long-term disaster. The credit card trap. One of the most alarming trends is the rise of credit card dependency. Even products that used to feel affordable, like basic household goods, are seeing persistent price increases that strain everyday budgets. By mid-2023, total credit card debt in the U.S. surpassed $1 trillion, a record high. With interest rates at all-time highs, carrying a balance has become a financial trap. Delinquencies are also on the rise, with missed payments hitting levels last seen during the 2008 financial crisis. It's not just households bearing the brunt. Small businesses, often hailed as the engine of the economy, are grappling with higher borrowing costs and reduced consumer spending. With loans harder to secure and customers cutting back, many small businesses are facing closures. The global ripple effect. The U.S. economy doesn't operate in isolation. Rising interest rates and inflation in America are sending shockwaves through global markets. Other countries, particularly emerging economies, are dealing with their own debt crises as borrowing costs soar. This interconnectedness means the stakes are even higher for finding solutions to this economic turmoil. What happens? If this continues, the consequences of this crisis could be far-reaching. Consumer spending declines. Note, with more income directed toward debt repayment, discretionary spending is shrinking. This hurts businesses and slows economic growth. Economic inequality widens. Wealthier households can weather higher costs, but middle and lower income families are increasingly falling behind. The Federal Reserve's aggressive rate hikes may aim to tame inflation, but the unintended consequences are being felt on Main Street, where households and small businesses are struggling to cope with a landscape of higher costs and reduced opportunities. Financial crises loom. Rising defaults on loans could destabilize banks and lead to a broader financial crisis. How to protect yourself. Amid this economic uncertainty, there are steps you can take to safeguard your financial well-being. Reduce high-interest debt. Pay down credit cards and other high-interest loans as quickly as possible. Build a budget. Identify areas where you can cut costs and funnel savings into paying off debt or creating an emergency fund. Invest wisely. Protect your savings by diversifying into inflation-resistant assets like stocks or real estate. Stay informed. Keep up with economic trends so you can adapt your strategies. The path forward. This crisis is not just about numbers or statistics. It's about people. Families, small businesses, and communities are all feeling the strain. While policymakers grapple with solutions, the best thing you can do is take control of your own financial destiny. The storm isn't over, but by staying informed and proactive, you can navigate it with resilience.